What's happening in the silver market right now is something most people aren't paying attention to, and that's exactly the problem. While everyone's distracted by the headlines, a perfect storm is building that could make the next few days absolutely critical for anyone who understands what physical silver really represents. I'm going to walk you through exactly why this window matters, and why waiting even a week could mean missing something that only happens once in a generation. Let me start with what's actually happening on the ground, because the numbers tell a story that should concern anyone holding dollars right now. The silver market has been in deficit for 6 consecutive years. Think about what that means. 6 years where industrial demand, investment demand, and central bank activity have consumed more silver than the world's mines can produce. We're not talking about a temporary imbalance. We're talking about a structural shortage that's been quietly draining available supply while most investors chase the latest tech stock or cryptocurrency. Here's where it gets interesting. The solar panel industry alone has been consuming silver at rates that would have seemed impossible just a few years ago. Every single solar panel requires silver for its photovoltaic cells. It's not optional. It's not something they can easily substitute. And as the world races toward renewable energy, that demand isn't slowing down. It's accelerating. But here's the twist that most analysts missed until recently. Silver prices surged so dramatically that solar manufacturers started scrambling to find alternatives. They're trying to replace silver with copper in their panels. You know what that tells me? It tells me that industrial users are terrified of where silver prices are headed, and they're willing to completely redesign their manufacturing processes to reduce their exposure. Think about that for a second. These are massive corporations with billions in infrastructure, and they're retooling entire production lines because they can't afford silver at these levels. What does that say about where they think prices are going? And here's the kicker. Even with all this effort to reduce silver consumption, the market is still in deficit. The demand is so overwhelming that even with substitution efforts, there's not enough silver to go around. Now, before I go further, I want to mention something quickly. If you're watching this and you're thinking about your retirement security, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No obligation. Just information that might be relevant to your situation. All right, back to what's happening with silver. Let's talk about the COMEX for a minute, because this is where things get really fascinating. The COMEX is where silver futures trade, where the paper price gets set. And right now, we're seeing something that veteran traders are calling unprecedented. The amount of physical silver available for delivery at the COMEX has been dropping steadily. We're talking about inventories that are a fraction of what they were just a few years ago. Meanwhile, the number of contracts demanding physical delivery has been climbing. You see the problem here? More people want the actual metal, and there's less of it available. This creates what's called a squeeze. And not just any squeeze. We're talking about a situation where the paper market, where most silver trading happens, could potentially decouple from the physical market. Imagine you're holding a contract that says you own silver, but when you try to take delivery, they tell you there's a waiting list, or worse, they offer you cash settlement instead. That's not a theoretical scenario anymore. That's becoming a real possibility that's keeping bullion dealers up at night. Let me tell you about something that happened back in 1980 that most people have forgotten. The Hunt brothers tried to corner the silver market. They accumulated massive positions, and silver went from around $5 an ounce to over $50 in a matter of months. The establishment panicked. They changed the rules mid-game, restricted trading, and forced liquidation. The Hunt brothers lost billions. But here's what's different now. This isn't a few wealthy individuals trying to manipulate the market. This is fundamental supply and demand. This is industrial users competing with investors, competing with central banks, all chasing a finite resource that's being consumed faster than it's being produced. The geopolitical dimension adds another layer that most people aren't considering. We're watching the largest de-dollarization movement in modern history. Countries that have relied on the dollar for decades are actively diversifying into hard assets. Gold gets most of the attention, and rightfully so. Central banks have been accumulating gold at record pace. But silver? Silver is gold's little brother that everyone underestimates. It's more volatile, more industrial, and potentially more explosive when supply constraints hit. BRICS nations now hold a significant percentage of global gold reserves, and they're not stopping. They understand something that most Western investors are just starting to grasp. When you hold physical precious metals, you hold something that can't be printed, can't be inflated away, and can't be seized through monetary policy. It's real wealth in a world of increasingly questionable paper promises. Here's where the timeline becomes critical. The silver market operates on very thin margins of available supply. When I say you need to act before Friday, I'm not being dramatic. I'm looking at delivery schedules, at refinery capacity, at the logistics of actually getting physical metal from producers to consumers. There are bottlenecks in this system that most people don't see until it's too late. Refineries are running at capacity. Shipping times have extended. Premiums over spot price have been climbing because dealers know that replacing inventory is getting harder and more expensive. Let me paint you a picture of what happens when a supply shortage hits a market like this. It's not like stocks where you can just buy more shares. Physical silver has to be mined, refined, fabricated, and delivered. That process takes time. When demand spikes and supply is already tight, premiums explode. We've seen this before in smaller episodes. In 2020, during the pandemic, silver premiums went from $2 or $3 over spot to $8, $10, even $12 over spot for retail products. And that was just a temporary disruption. What we're looking at now is a structural shortage that's been building for years. The smart money has been positioning for this quietly. Large institutional buyers have been accumulating physical silver through private transactions, off-market deals that don't show up in the public data until months later. They're not waiting for confirmation. They're not waiting for CNBC to tell them it's time to buy. They're acting on the same data I'm sharing with you right now, and they're doing it while supply is still available at anything close to reasonable premiums. Now, let's talk about what 50 ounces actually represents, because this isn't an arbitrary number. 50 ounces of silver is enough to be meaningful. It's enough that if silver does what many analysts expect, you're looking at a position that could significantly impact your financial security. But it's also accessible. It's not like I'm telling you to buy 1,000 ounces or 10,000 ounces. 50 ounces is achievable for most people who are serious about protecting their wealth. Think about it this way. If you're holding cash right now, you're holding a depreciating asset. The purchasing power of your dollars is being eroded by inflation, by monetary expansion, by policies that prioritize short-term economic stimulus over long-term currency stability. Silver, on the other hand, is a tangible asset with industrial utility, investment demand, and a supply situation that's getting tighter by the day. Which would you rather hold? The historical precedent here is important. Every time we've seen a major monetary crisis, precious metals have served as a wealth preservation tool. In Weimar Germany, people who held gold and silver survived the hyperinflation that destroyed the savings of everyone holding paper marks. In Zimbabwe, in Venezuela, in Argentina, the pattern repeats. Paper currency fails. Hard assets endure. I'm not saying we're headed for hyperinflation tomorrow, but I am saying that the conditions that lead to currency crises are present in ways that should concern anyone paying attention. Let me address something that skeptics always bring up. They say, but silver is so volatile. Look at how much it swings. And they're right. Silver is volatile. It can move 5, 10, even 15% in a single day. But here's what they're missing. That volatility works both ways. And when silver moves up, it moves up fast and hard. We've seen silver double in a matter of months during previous bull runs. We've seen it triple. The volatility that scares people away is exactly what creates the opportunity for those who understand the fundamentals. The gold-to-silver ratio is another piece of this puzzle that's absolutely fascinating. Historically, this ratio has averaged somewhere around 60 to 1, meaning it takes about 60 ounces of silver to buy 1 ounce of gold. Right now, we're seeing that ratio compress as silver outperforms gold on a percentage basis. When silver starts catching up to gold in terms of investor attention and capital flows, the moves can be spectacular. We saw this in 2011 when silver went from around $17 to nearly $50 in less than a year. The ratio compressed dramatically, and silver investors made fortunes. What's different this time is the supply situation. In 2011, there was still plenty of silver available. Mines were ramping up production, refineries had capacity. Now, we're already in deficit. Production is constrained. New mines take years to develop. The supply response that eventually capped silver's rise in 2011 isn't coming this time, at least not quickly enough to prevent a significant price spike. Here's something else most people don't realize. A huge percentage of silver production comes as a byproduct of other mining operations. Copper mines, lead mines, zinc mines. They produce silver as a secondary product. When those base metal prices are low, those mines cut production, and silver supply drops even though silver prices might be rising. It's a weird dynamic that creates supply inelasticity. The market can't just produce more silver in response to higher prices the way it can with some other commodities. Now, I want to talk about something that's relevant if you're thinking about your retirement accounts. If you're sitting on $100,000 or more in a 401k or IRA, there are ways to get physical precious metals into those accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers the process, the rules, the custodians you need to work with. This isn't about selling you something. It's about education. Because in times like these, when we're seeing currency instability, geopolitical tension, and supply shortages in critical commodities, having a portion of your retirement in physical assets that you actually own makes a lot of sense. Check it out if that's relevant to your situation. All right, back to the immediate situation. The reason Friday matters is because of how the physical silver market operates. Dealers place orders with distributors. Distributors place orders with refineries. Refineries schedule production based on demand. When you order silver today, you're not just buying what's sitting on a shelf. You're getting in line for production and delivery that's already scheduled out weeks or even months. The earlier you act, the better your position in that queue. I've been talking to dealers who are telling me that delivery times have already extended significantly. Products that used to ship in a few days are now taking weeks. Some popular items are on back order with no clear delivery date. This is happening while prices are still relatively stable. Imagine what happens when the broader market wakes up to what's happening. When mainstream media starts covering the silver shortage. When retail investors start piling in. The premiums will explode and availability will evaporate. Let me tell you about the psychology of markets because this is crucial. Markets move in waves of emotion, fear, and greed. Right now, most people are complacent. They're not worried about their dollars. They're not thinking about supply shortages. They're not positioning for what's coming. That complacency creates opportunity for those who are paying attention. But complacency doesn't last forever. Eventually, something triggers awareness. A news story, a price spike, a shortage that becomes undeniable, and then everyone tries to act at once. That's when you get the panic buying. That's when premiums go from $3 over spot to $10 over spot overnight. That's when dealers run out of inventory and stop taking orders. That's when you wish you had acted when you had the chance. I've seen this pattern play out in multiple markets over the years. The people who win are the ones who act before the crowd. The people who lose are the ones who wait for confirmation that never comes at a reasonable price. The industrial demand story is particularly compelling because it's not speculative. Solar panels need silver. Electronics need silver. Medical devices need silver. 5G infrastructure needs silver. Electric vehicles need silver. These aren't maybe demands. These are hard requirements for technologies that are growing exponentially. And unlike investment demand, which can come and go based on sentiment, industrial demand is sticky. Companies need the metal to manufacture their products. They can't just decide not to buy because the price went up. This creates a floor under silver prices that didn't exist in previous cycles. Even if investment demand were to drop off, which I don't think it will, industrial demand alone is enough to keep the market tight. And when you combine industrial demand with investment demand with central bank diversification with supply constraints, you get a setup that's truly extraordinary. Let me talk about the paper market versus the physical market for a minute, because this distinction is critical. Most silver trading happens in the futures market. Contracts that represent silver but aren't actually backed by physical metal in a vault somewhere. It's a leveraged, speculative market where banks and hedge funds trade massive positions. The price you see quoted, the spot price, is determined by this paper market. But here's the thing. When push comes to shove, paper promises don't matter. What matters is physical metal that you can hold in your hand or store in a secure vault. We're starting to see signs that the paper market and the physical market are diverging. Premiums on physical products are rising even when the spot price is flat or down. That's telling you that the real market, the market for actual metal, is tighter than the paper market suggests. This divergence can only go so far before something breaks. Either the paper price has to rise to reflect physical reality, or the paper market loses credibility entirely. Either way, people holding physical metal are in a much better position than people holding paper contracts. The LBMA, the London Bullion Market Association, is another piece of this puzzle. They're the ones who set the standards for good delivery bars, the large bars that trade between institutions and central banks. There have been persistent rumors about tightness in the LBMA market, about delays in delivery, about concerns over whether there's actually enough physical metal to back all the claims. These aren't confirmed facts. They're rumors. But where there's smoke, there's often fire. And the smoke in the precious metals market is getting thicker. Think about what happens if confidence in the paper market cracks. If people start demanding physical delivery en masse, the system isn't designed to handle that. There isn't enough physical metal to satisfy all the paper claims. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their money at once. Then you get a run. And runs in commodity markets can be even more dramatic than runs on banks because there's no central bank that can print more silver to calm things down. The Chinese have been particularly aggressive in accumulating silver. They understand the industrial importance. They understand the monetary importance. They're building strategic reserves while Western investors are largely asleep at the wheel. When China moves in commodity markets, they move size. They're not buying a few hundred ounces here and there. They're buying thousands of tons. And they're doing it quietly, through state-owned enterprises and private companies that don't have to report their positions publicly. Russia has also been accumulating precious metals as part of their de-dollarization strategy. After sanctions cut them off from Western financial systems, they realized the vulnerability of holding dollar-denominated assets. They've been converting reserves into gold and silver, into commodities that can't be frozen or seized by foreign governments. Other countries are watching and learning. The lesson is clear. Physical assets under your control are safer than digital claims on foreign banks. This geopolitical shift is massive, and it's accelerating. The dollar's role as the global reserve currency is being challenged in ways that would have seemed impossible a decade ago. Countries are settling trade in their own currencies. They're creating alternative payment systems. They're reducing their dollar holdings. And they're increasing their holdings of hard assets. This isn't a conspiracy theory. This is documented policy from multiple governments around the world. What does this mean for silver? It means that the monetary demand for precious metals is returning after decades of dormancy. For most of the post-1971 era, gold and silver were seen primarily as commodities or inflation hedges. Now they're being seen as monetary assets again, as alternatives to fiat currency, as stores of value that transcend national borders and political systems. This shift in perception is profound, and it's driving demand from sources that weren't active in previous cycles. The supply side of the equation is equally compelling. Silver mining is a tough business. Ore grades have been declining for years. The easy deposits have been mined out. New discoveries are rare and expensive to develop. Environmental regulations make permitting new mines increasingly difficult and time-consuming. Even when silver prices rise, the supply response is slow because of these structural factors. You can't just flip a switch and produce more silver. Recycling provides some supply, but it's limited. Unlike gold, which is mostly held in forms that can be easily recycled, silver gets consumed in industrial applications. It's used in tiny quantities in electronics, in solar panels, in medical devices. Recovering that silver is often not economically viable, so a significant portion of silver production is effectively lost to industrial consumption. This is unique among precious metals and creates a supply dynamic that's much tighter than most people realize. The investment demand side is just starting to wake up. ETF holdings have been growing, but they're still well below the peaks we saw in previous bull markets. Retail buying has picked up, but it's not at panic levels yet. Institutional interest is building, but it's still early. When these sources of demand really kick in, when the momentum traders and the hedge funds and the family offices all decide they need silver exposure, the available supply will be overwhelmed almost instantly. I want you to think about your own situation for a minute. What percentage of your wealth is in physical assets that you control? Not stocks, not bonds, not even real estate that's mortgaged. I'm talking about assets that you can hold, that have intrinsic value, that will still be worth something if the financial system has a hiccup. For most people, that percentage is close to zero. Their entire net worth is tied up in paper assets that depend on the continued functioning of banks, brokerages, and government institutions. I'm not saying you should put everything into silver. That would be foolish. Diversification matters. But having some portion of your wealth in physical precious metals is just prudent risk management. It's insurance against scenarios that might seem unlikely, but would be catastrophic if they occurred. And unlike most insurance, this insurance has the potential to appreciate significantly if the scenarios I'm describing play out. The 50-ounce target I mentioned at the beginning isn't arbitrary. It's enough to be meaningful. It's enough that if silver does what the fundamentals suggest it should do, you'll be glad you acted. But it's also manageable. It's not going to break the bank for most people who are serious about their financial security. And it's divisible. You can sell some if you need to. You can hold some for the long term. You have flexibility. Storage is something people worry about, but it's not as complicated as you might think. For 50 ounces, you're talking about a package that's smaller than a shoebox. You can keep it at home in a safe. You can use a safety deposit box. You can use a private vault service. There are options for every comfort level and security preference. The key is that you own it. It's not a claim on someone else's silver. It's your silver, under your control. The tax implications are worth understanding too. In most jurisdictions, silver is treated as a collectible for tax purposes. That means capital gains are taxed at a higher rate than stocks or bonds. But here's the thing. If you're buying silver as insurance, as wealth preservation, you're not planning to flip it for a quick profit. You're holding it for the long term. And if the scenarios we're discussing play out, the tax on your gains will be the least of your concerns. You'll be happy to pay it because it means your wealth was preserved while others lost everything. Let me bring this back to the immediate timeline. Why before Friday? Because the market is at an inflection point. The technical indicators are showing strength. The fundamental supply-demand situation is tightening. The geopolitical backdrop is supportive. The industrial demand is accelerating. All the pieces are in place for a significant move higher. And when that move starts, it's going to be fast. You won't have time to research, to compare dealers, to figure out logistics. You need to be positioned before the move happens. I've been in this market long enough to recognize these setups. They don't come along often, maybe once or twice a decade, and when they do, the people who act decisively are the ones who benefit. The people who hesitate, who wait for more confirmation, who want to see what happens first, they end up chasing prices higher or missing the move entirely. Don't be that person. Think about the regret you'll feel if you're watching silver prices double or triple over the next year and you didn't act when you had the chance, when you could have bought at reasonable premiums with good availability. That regret is far worse than the regret of buying something that doesn't work out. Because at least with silver, you still have the metal. You still have something of value. It's not going to zero. It's not going to disappear. It's a tangible asset with thousands of years of history as a store of value. The narrative around precious metals is changing. For years, they were dismissed as barbarous relics, as investments for doomsday preppers and conspiracy theorists. That narrative is crumbling. Mainstream institutions are starting to acknowledge the role of gold and silver in a diversified portfolio. Central banks are leading by example, accumulating at record pace. The smart money is positioning. The question is whether you're going to position with them or wait until it's too late. I want to emphasize something important. This isn't about getting rich quick. This isn't about speculation or gambling. This is about wealth preservation in an uncertain world. It's about having a portion of your assets in something real, something tangible, something that's been valued for millennia. Silver has been money for longer than any fiat currency has existed. It survived empires, wars, depressions, and hyperinflations. It will survive whatever comes next. The opportunity in front of you right now is to acquire physical silver at prices and premiums that may not be available much longer, to position yourself ahead of what could be a historic move in precious metals, to take control of a portion of your wealth in a way that removes counterparty risk and gives you true ownership. 50 ounces is the target. Before Friday is the timeline. The reasons are everything I've laid out in this video. For those of you who've watched this far, I want to offer something additional. In the description, there's information about a free one-on-one educational web conference. No obligation, no sales pitch. Just education about how to protect your wealth using strategies that thousands of American retirees are already implementing. This is specifically for people with at least $100,000 in retirement accounts. If that's you, and you're serious about understanding your options, mention that you watched this video to the end. That gets you access to the exclusive session. The world is changing faster than most people realize. The financial system that's been in place for decades is showing cracks. The dollar's dominance is being challenged. Supply chains are fragile. Geopolitical tensions are rising. In times like these, having a portion of your wealth in physical assets isn't paranoia. It's prudence. It's what smart people have done throughout history when they saw storm clouds gathering. Silver represents an opportunity that combines wealth preservation with significant upside potential. The supply-demand fundamentals are as compelling as I've ever seen them. The geopolitical backdrop is supportive. The technical setup is strong. The timeline is now. Not next month, not next year. Now. Before the window closes, before premiums spike, before availability disappears, before the crowd wakes up and tries to act all at once. You have the information. You understand the situation. The question is whether you're going to act on it, whether you're going to take control of your financial future in a way that removes dependence on systems that are showing increasing signs of stress. 50 ounces of silver before Friday. That's the message. That's the opportunity. The choice is yours.